the target is not as important as the path of the arrow. Be active, not passive, in this time of challenge and change. And we can be the arrow, not the target. Change is inevitable, but it's different from drifting with the change. And every time we deviate from the path, we move our target. So let's talk about order blocks. Hey, what's up, guys? So let's talk about the grid, of course. But first, let me just make some comments about order blocks, okay? Because this is a very important concept. And if you really want to improve your trade, you have to know about order blocks. What are they and how can you use them? Imagine a place in the market. The banks are buying, okay? So you can basically identify where the big guys are placing their orders. We have a bearish order block or we have a bullish order block. So how can you find them and why this is important? At first, I have no idea, but we have everything backwards. So it's totally opposite to, what institutionals are looking for. If you have a bearish order block, you have to look for the last bullish candle before a strong push to the downside. And if you have a bullish order block, you have to look and find the last bearish candle before a strong push to the upside. So let's have a look at this chart, okay? So you see the move, okay? And then you just see, the last bullish candle. And this is actually a bearish order block. So there is a consolidation zone. Then after the contraction zone, there is this spike. Something that, Gonzalo would say, oh, this is a spring or something. I don't know much about Wyckoff, but what really matters is you have to know these areas because those areas, they show momentum, okay? So this is a supply zone. This is a bearish order block, okay? So if it's a bearish order block, you have to find, the green candle, or in this example, the blue candle. And then you select this candle from wick to the whole body, and you wait. Because this is a very important zone where institutionals, they're basically distribution. So let's draw the order block, all the way across here. So here is the price. And then we have a strong push to the downside, and then a pullback, and then the move go, okay? So after the move goes, let's take a look at this green line. So this is the equilibrium, okay? This is the 50% zone where I know there's going to be a sell-off there. And you can have two kinds of trades, right? One trade starts when, the bottom of the order block is broken. And the other one, you can start the trade after, if there is a pullback, okay? You can draw there and starting from 50%, okay, of that order block. Just reviewing the bearish order block is the last bullish candle. The bullish order block is the last bearish candle. So my mentor would call it this a red bar ignored, or an RBI. What I'm going to show you is where's the entry, okay? If should a pullback happen, then you can enter for the second time. And I usually draw this sometimes. Perhaps you remember from my drawings. If you once, open my charts and took a look. So take a look. Those are very good risk-reward trades. It's 5-1, the one from the right. But if you take a look here on the left, you can see where the previous move stopped. And it was right there. So those two trades, the possible trades, they were 3-1 and 5-1, which is awesome actually. I wouldn't trade, below that level, but it's possible to. I mean, the move went there, but I wouldn't be there actually. You don't need to catch like a gazillion points, ticks, or pips. If you trade, a smaller range, then you can add more lots if your risk is small. If you have a huge risk, you'll never have a huge risk, but if you have several pips as a stop loss, you have to risk less lots, less shares, and that's how it works. So here you can see the last bearish candle before the bullish move, right? So this is the bullish order block, okay? Okay, let's draw. And that's it. And it's impressive how the move goes, and we have a pullback right there. So if you remember that line, exactly where 50% here in the order block, you can have a buy right now. And where's the target? You have to calculate, okay? But basically you can go from a bullish order block to a bearish order block, okay? So you can notice that one trade starts 50% there, right there on the green line, and the second trade, it's where the bullish order block starts. If you go from the actual bullish order block to the previous bearish order block, if you risk 1%, can you believe it? It's almost a 3-1 risk reward, and it's awesome because if you trade like one trade or two trades like this, you were trading actually the same trade, but this is like scaling, right? If you're not trading the grid, order blocks, they will basically improve a lot your trading. You just have to be able to see it and draw it until you're confident and you're using a lot. Of course, if you have a higher time frame, the order block is way more important than 1 minute or 5 minutes. But basically 1 hour and 4 hours and daily are the best order blocks ever. So I think because this concept is so simple, we should use it more. Okay, let's see here. Where's the last bullish candle? Okay, it's right there. So you can draw, the box. And you have to understand that we really have to have a major move, okay? It's not like a small move to the downside, okay? And this is quite important. So when can you say that the order block is invalidated? Well, if you consider the line, the green line, and the prices, they invade that line. They go to the top of the order block. So this is actually not good, okay? So it's a bit risky, this trade, but let's see if you can do this, okay? So one starts in the middle of the order block, and the second one starts in the bottom, okay, when price breaks down from that bearish order block, okay. And where's the target? This is actually good, okay, because we have a lot of liquidity void there, meaning that the price didn't stop anywhere and we can take advantage. So 5-to-1 risk reward, and well, both trades really good. I think I can hold the trade for a bit longer, but 9-to-1, awesome. Okay, so we have a downtrend here, and then out of nowhere this thing just pulls back, and then we'll have to expect a move down. Right now you try to find the order blocks, and now you see that this is not hard. This is actually a pretty simple idea, and you can identify all institutionals trading, which is awesome. Okay, if you guys have questions, just let me know. Okay, this is our grid, right? So the grid is basically several buys and several sells that you put there, and you have a metric to do that. Of course, each of them has a different stop, okay, according to your metrics. So the metrics I use here, I had a sell every 97 drop, okay, for my horizontal lines, and my target was 140 pips, okay, and this is a lot, okay. Looking there at the entry and exit, okay. So basically I have my grid here, and my grid has been profitable for 1, 2, 3, 4, 5, 6, 7 days now. Of course it can be just a coincidence, okay, but it's a lot, guys. It's 5,315, okay. So, and this has everything to do with the metric and the formula, okay, that Randy gave me, and it's impressive, right? So this is the Bankster's Math high and the Bankster's Math low. So you get this number, and this number is the whole move, your working area, where it says there move, okay? And your stop loss is basically this area divided by 2, okay? So if you get the whole move, or you just the stop loss, I usually just use, the stop loss, and I divide it by my entry, which is 97, then I know that I could have done today 6 contracts. I had 9 hits today, okay? It was a lot. And it happened, actually, I had 10, right? It was really impressive, really, really impressive. And I don't do this, just math like my friends, they do, my quant friends. I use a little bit of technical analysis. So this order block concept that I told here, plus the grid, I think we can even do this with oil, really. Okay, so stay tuned, and thanks for watching.